Hello, 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 hello. Here we are talking about One Big Beautiful Bill Act. And today we are going to talk about this bill's um, effect, this bill's impact on our retirement and retirement planning. Well, there are a lot of things in these big, beautiful bills. There are a lot of tax changes which are permanent. There are a lot of things which are temporary. We are not going to touch on all of them. There are too many. The summary of the bill, the link to the summary is in the description. It's a free book. You don't have to leave your email or do anything. Just go to the link and flip through the book. If you want a PDF copy, we did send it in an email to our clients, but if you didn't get it and you want the PDF copy, let us know. We'll send this copy to you. Wow, there are a lot of changes there. However, there are some changes which will affect almost everybody, at least almost all of us and our clients. Number one, the current low tax brackets, which were supposed to expire and go away December 31st, 2025, are now permanent. And I do permanent on purpose. I will explain why. The seniors received, people who are 65 and older received a bonus deduction, which is temporarily only for 4 years, 25, 26, 27, 28, of additional $6,000 deduction to their income. Yay, that's great. SALT, state and local income taxes, are capped now at $40,000. Now, these two deductions are subject to income limitations, and the higher income is, once you reach certain levels, they will start phasing out. And so there are also Trump babies accounts and all the other stuff. It's all in the summary. Well, why are we talking? We want to focus on tax brackets today. Why? Because now some people are wondering, well, when the tax brackets, this wonderful low income tax bracket, as low and declared permanent, they're never going to go away now, why should we convert? Irina and Curtis, you've been beating this drum. Convert to tax-free, convert your tax-deferred accounts, your IRAs, 401ks, 403bs, defined benefit plans, convert to Roth accounts or other tax-free vehicles. Why do we need to do it now? Well, let's talk about it. First, let's define permanent in tax law. First, nothing in tax law is permanent. Tax law is written in pencil, and our government has a big giant eraser at any time. They can come to the tax code and change it. What's the difference between temporary and permanent? Temporary tax provisions have certain dates which they expire or sunset automatically if Congress does absolutely nothing. Permanent means that in order for these things to change, Congress has to vote on it and the president has to sign it into law. That's the difference. So now let me share my screen and let me show visually what we are talking about. All right, so here is not the slide I wanted. Here is our top marginal. And you can see they have been changing all the time. So the only permanent thing about taxes is that they're constantly changing. And as you can see over here, if you can see here, we are relatively to the whole history. We are in low tax brackets right now, right? All right, now let's go to another slide. These are all selected slides. I'm just picking up my favorite numbers I want to point out from different presentations we make. All right, so here is total revenue, taxable tax revenue right now at current tax laws before Big Beautiful Bill, $4.9 trillion. And here is expenses. And they are separated into two different groups, mandatory or non-discretionary spending. Those are Social Security, Medicare, Medicaid, and interest on national debt, which government cannot negotiate. They have to pay it. This is mandatory spending. They cannot change it. The entire revenue goes to cover these four expenses. But then we have a gazillion, plentiful of discretionary expenses, such as defense, education, transportation, you name it. So those are discretionary expenses, and we have to pay them. Like our country has to have them in order to function properly. And those are right now, they add up to $1.2 trillion. But what does it mean? You see, total spending right now is $6.7 trillion. It means that we have $1.8 trillion gap every year. And now with the Big Beautiful Bill, this total revenue number will be smaller. And they're trying to change, they're trying to minimize and cut back on the discretionary expenses. This does not go well. We all have seen it, right? So, and unfortunately, due to aging population, the pressure on Social Security and Medicare will keep increasing. So our non-discretionary expenses will be increasing. And therefore, this gap, Congressional Budget Office is projecting that this gap will increase from 1.8 trillion to somewhere between 2 and 2.9 trillion dollars. Let's say 2.5. Still, not good news, right? Now, let's look at US national debt over last 100 years. Well, right now, this is an old number. Last quarter, we were at $36.2 trillion. We are over $36 trillion. So at this rate, by the end of 2028, when we anticipate the tax laws will start changing again. A lot of temporary deductions will sunset, and the Congress will start doing something about taxes. So by 2028, the total debt will be pushing, at this rate, will be pushing 47, 48, maybe $49 trillion, very close to $50 trillion. That's a scary number. This is not good. But I wanted to indicate one interesting thing. I don't know if you can see my cursor where I'm pointing. Look at the history, the historical graph. Very low debt, then there was World War II, so we kind of, we got in debt a little bit, then we paid it off, and it stayed under control from the 50s through the mid-80s. It was under control, looks like, right? Now, let's look at tax graph. Here it is. The taxes during that period, look how high the taxes were. The top marginal tax bracket was at least 70% through the entire time. We are not talking about 1945 when it was 94%, but through the entire time, it was at least 70%. Then 1981 happened, and boom, we decreased it a little bit, and then boom, Congress decreased the taxes again, and boom, they decreased taxes again, then they raised them a little bit, then they lower them, and now we are here in the lowest and the long time, lowest taxes. Now you see 1981. Let's go back to this slide. Look what started happening in 1984 to the debt. The debt started spiraling out of control. Ladies and gentlemen, if we can see it, Congress members can see it too. When this number goes to high 40s, when it's over $45 trillion, wouldn't it be obvious that our government will decide that they do need more revenues, and maybe from here, just to take debt under control, from here, we will have to come over here to the higher tax brackets. And hey, it doesn't matter if you are red, blue, or purple. I don't care. It doesn't matter. What matters is that we have this history, and the correlation between the tax rates and the debt levels, it's telling, right? So what should we do? When people ask me, do we still have to convert? And the answer is, well, maybe, right? And it's not actually maybe, it's absolutely yes. We should convert. I need to stop sharing the screen. We should convert. Convert, convert, convert. We got a gift. 4 years, 4 additional years of super low tax rates and tax brackets which are favorable for us. We need to use them. We need to use these 4 years because, hey, listen, we are not going to be retired just for 4 years. Some of our clients will not be retired in 4 years. We will be retired for 20, 30, maybe 40 years. So we need to take advantage of the current window of opportunity and do what? Convert to tax-free accounts. Right now, taxes are cheap. Tax sale got extended. Let's take advantage of this sale. Let's pay taxes now. So in future, when the government decides to make some changes, they change tax brackets, they would change income levels with current tax brackets. They might increase other fees like IRMA or taxable portion of Social Security or taxable portion of your wages, which are subject to Social Security taxes. They can do a lot of things, but your income and from your Roth accounts and supplemental income from your other accounts like life insurance, retirement plans, they don't care. They don't count towards all these limits and calculating all those brackets and adjustments. We do have a little nifty tool, which the link is in the description, where you can estimate your tax savings in retirement. All you need to do there is to put your age and how much money you have on your tax deferred account total, and you will get a very rough estimate of what it's going to be, how much money you could potentially save. Now we can fine-tune that report and play some what-ifs analysis and put different types of income in there. That's more involved, and you can reach out, let us know that you want to see this report, and we'll create one for you. And let me show you what it would look like. It is here. So it will look something like this, and that's the rough estimate. Basically, it shows you how much taxes you will pay, but we can create a more detailed, more sophisticated report for you. So all you need to do, just let us know that you want it. So what else? That's pretty much it for now. we'll continue talking about this subject because I want people to get the point that right now we've been given a wonderful gift, wonderful opportunity. Let's use it. Thank you for watching. This is Serenity Wealth Management. If you like this information, please like this video and subscribe so you'll get notified when we post these. If you have some specific questions or concerns, reach out to us. We'll address them. We love doing that. And again, all the contact information is in the description. So don't be shy, reach out. And until the next time, next week, have a wonderful, wonderful week.